Hello, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back, and thank you for joining us. Don't forget to like and subscribe. Click the bell to get a notification of when we release a new video. I'm sitting again with Nick Rogers. Nick, thanks for joining us.
Pleasure, Robin.
Nick, the last 10 days, we're sitting here Monday, the 19th of September. The last 10 days have been pretty torrid on the markets. We've seen the Rand weaken. We've seen the American markets have some really difficult days. And I know that in earlier Money Morsels during the early start of this year, we talked about the fact that we expected volatility as this concern around inflation sort of hangs around. But what has really driven this last 10 days of volatility? Can you maybe give us some insight?
Sure, Robin. Look, I think if we go to the beginning of this year, we have the world coming out of COVID and sentiment going positive that we're out of the worst, only to find in the 28th of February Russia invading Ukraine, it's proved to be a disaster on the inflation front because of the oil, because of European energy prices. So that was a curveball which wasn't expected. To solve the COVID issue, at the time, governments around the world, central banks printed vast amount of money, which they dwarfed 2008 levels by probably 2 or 3 times. That money had to go somewhere, and that's what caused the initial inflation. Unfortunately, the Fed called it transitory inflation. Obviously, they didn't know the war was coming, so that didn't play out. And earlier in I think it was last month at Jackson Hole, the Fed came out and gave quite a hawkish statement about where interest rates need to go to quell inflation, which the market wasn't expecting. So the tone of the Fed is watched very closely, and the market took it negatively. When there's an issue like this, the money flows back into the dollar. It's always been a global safe haven. So at the moment, what we're seeing is not Rand weakness. We're seeing dollar strength. So all the currencies around the world, the Aussie, the Brazilian real, the pound, you name it. Well, the pound, I think, is at a 35-year low. So just to illustrate where we're at. But it's a global issue. Money's flowing back to the Fed, and central banks are going to have to be more hawkish and increase their rates a lot more than was expected. And that's got the market on the back foot.
Yeah. So, revisiting what Michael spoke to us in an earlier Money Morsel about higher interest rates means that the valuation on companies is obviously affected because your capitalization rate that you're doing the calculation on is a higher interest rate, which automatically means a lower price for a set flow of earnings. Is that part of why the markets have also been under pressure? It's just this revaluation based on higher interest rates expected?
Yeah, correct, Robert. The market looks forward. It looks into the future, and it prices or reprices accordingly. So what we're seeing at the moment is with inflation and with all the input costs around the world going up, your profit margins are being squeezed. So that affects your earnings overall. So the earnings are going to be probably on the back foot for the next year. Thus, the analysts are revaluing the companies, and that's causing the capital side of the equation to come down. But again, we just reiterate that your dividend in the background comes into play during these times. This is where it just ticks in month after month, supporting the portfolio. So, don't get caught up in the capital movements at this particular time.
Yeah, and I think dividends are actually looking quite healthy. And remember, what the exciting part is that when share prices are low and you're getting dividends, that's the opportunity to buy shares at a deep discount. Nick, thanks for joining us. It's great to have you with us. Please tune in again next time. Go well.